Hey guys, welcome back to another video from me. Thank you so much for sticking around. As you know, Ukraine made a big impact on me because I live quite near the border. So I wasn't able 3 weeks ago and 2 weeks ago to make a video. I also had to look after some refugees. But hey, I'm in a better situation now. I'm still recovering from COVID, but I thought I feel good enough again to share some of my thoughts, some of my insights that I gained over the last week when I was studying insurance stocks. Particularly, I was updating the post on my blog about Dutch dividend stocks, as you can see, and all the time my attention is attracted towards ASR Nederland. They currently pay a 5.8% yield, a dividend per share of 2.42, and actually they have a relatively low payout ratio. And if you look at their growth track record from a dividend history point of view, in 2014 or 2013 they had their IPO spin-off from the government after nationalization during the great financial crisis. And since then, it has grew its dividend almost 3 times more than what it was back then. So of course, this took my attention and I started reading their annual report this week. And one of the things that caught my attention really here as well was the low interest rate environment as a risk. So what they are saying here that in 2021 interest rates remained at historical low levels, partly due to the quantitative easing of central banks. This potentially puts pressure on capital generation. And you need to know that insurance companies, they earn a lot of money by investing the premiums they collect from their clients. So in a low interest rate environment, of course, their profits are not so high. And this is really interesting to me because when I started looking at their balance sheet, look at it. 33.5 billion is based on investments out of the 75 billion on their balance sheet. This is one of the biggest accounts on the balance sheet that they need to earn money with. And if you look at it, what's in there? So the breakdown of the investments, 14 billion and 10 billion in bonds. These bonds, they generate almost nothing in return at the moment, right? So if we think about it, 25 billion here has really potential to grow significantly in a rising interest rate environment. And interest rates have been rising already quite steeply over the last few weeks. And as you can see here, if we look at all the different treasury rates from the American government and issued bonds from them, you can all see that it has been steeply rising due to the super inflation that we are seeing. So the Fed also started to increase the interest rates already. The ECB is still a bit in waiting mode, but I expect them to also announce this year at least maybe 1 or 2 more interest rates hikes. I know it's politically really sensitive with the Southern Europe countries, the Northern Europe countries, but I don't see another way out to cool down the economy that we're currently and the inflation that we're currently facing. So from that point of view, I'm actually quite optimistic already when we look at one of their biggest risks of a company like ASR, an insurance company, because it should do well for them. Don't you think so? So based on that, I thought okay, I was studying ASR, but let's look a little bit broader at which insurance stocks that are actually there. And I found 5 insurance stocks that I wanted to dive a little bit deeper in today, which I will show you today in this video. So as you know, the first stock that I would like to look into is ASR, and I will not repeat that one. The second stock that I would like to look into is NN Group, also a Dutch insurer, currently yielding 5.5% yield with a 41% payout ratio and a dividend growth track record of 7 years. The same here, this was an IPO out of ING, and ever since the IPO it has been growing their dividend, although you could see a small dip here between 2000 and 2017, and that had to do with the calendar year versus the fiscal year. So I'm not too tough on them from this point of view. Another company that I would like to look into is the German iconic Munich RE. It has already paying a growing or flat dividend since 1970. So that's quite a track record of 52 years, as you can imagine. So very loyal and very much rewarding shareholders over those 5 decades. The next one that I would like to look into is AFLAC. AFLAC has also been growing their dividends for 39 years uninterrupted, so no flat dividends, just purely growth. And as you can see at the chart, in 1993 it was paying 3 cents per share, and up till today it's paying 1.32 cents per share, which is really, really a lot. And even 1.60 per share. So if you were an AFLAC shareholder back in the early 90s, wow, you're getting a lot of dividends in return. Well, the last company then that I also would like to look into is MetLife. MetLife had a really tough period between 2007 all the way to 2012 because it had to keep their dividend flat, probably due to the great financial recession. But since then, it has been also, it's growing their dividend again, and it's now threefold from what it was, let's say, like 10 years ago. So let's look into these insurance stocks. All of these have an attractive yield as well, although you could argue that maybe the American ones have a bit of a lower yield, because if you compare them with each other based on the yield, let's say, then you can see that, for instance, the American ones are the lower yield companies in this overview. But also what is important to know is that they have, for instance, a payout ratio which is much lower than most of the others, because both of them have a payout ratio of about approximately 25%, and the European equivalents generally pay out more, and even 53 or 68% when it is related to Munich Re or the German Allianz. Other than that, what you can see is also that the price to earnings are really, really low for these, definitely trailing the market, because generally I believe the PE of the S&P 500 is around 20 or 22, and we're talking here about a PE of, on average now, what is it, 10 or something like that, 11. So yeah, 9.28. So that's really, really little. Okay, so what's important then if we look at comparing insurance company here? One of the most important metrics is looking at the combined ratio. I put the description in here for you as well. I will also put a link to this G-sheet in the description of this video so that you can have a look at it yourself as well. But what is a combined ratio effectively? Is like all the premiums that the company was able to earn, so earn premiums from the writing the policies to their clients, and then the losses they made on those policies and the expenses they made on those policies. And what you want, of course, is that you get in more premiums than that it costs you to underwrite those policies. So this is one of those most iconic ratios that you need to be aware of when looking into insurance companies. So when we have a look at it, we can clearly see that Munich Re, Allianz and AFLAC are actually really good in underwriting their policies, at least in 2021. MetLife was really poor at this, and I've been tracking also the last few years, and it's a continuous thing. So for me, almost because of this, MetLife already drops off of my list because they are not able to run a profitable business sustainably. What you need to know, of course, as well, is that most of their money of an insurance company is made by investments, right? So we saw that already in ASR when it comes to bonds and such. So it is important to take this into consideration. But generally speaking, you want a company to earn money on their core business if you consider that writing and underwriting policies is their core business. So if we look then at ASR, we can also see that it has been really having a poor year in 2021. But if you look at their annual report, they say like, we have an underwriting of 91% on the non-life, I believe. But life insurance for them is also part of it. So you always need to take those messages from the CEOs with a grain of salt, because sometimes they just give you half of the story. And I hate this, honestly. But if we look at ASR, this number is actually a little bit misleading, to be honest, because what we can see here is that their net insurance claims and benefits are 6.8 billion compared to 5 billion just 1 year ago. So what has happened here? And for this, I really like their annual report because it's so clear. And what we can see here is that their non-life went up from 2.7 to 3, so it's not the biggest one, right? But their life went up with 1.4. And there's one thing that caught my attention here, and that's the changes in liabilities arising from insurance contracts on behalf of policyholders. So effectively, they need to take a charge into the costs of the net insurance claims and benefits, because there are probably more contracts coming up in the future here. And this is also when we go further into the footnotes, what we can see here is again effect of fair value changes related to financial assets. So this had a 1.6 billion impact, which made the cost also, of course, much more. And this is one of those things you just need to look into when you're an investor, because you need to understand, is this a one-off or not? And when I dove a little bit deeper into it, I saw that this is more like a one-off. So if you take this out of the equation and you take, let's say, $1 billion off, you would say that it is approximately around 100%, or maybe even still, like the CEO says, in the low 90s. So from this point of view, I'm flagging ASR as a red because one-offs are important, but it's for you as an informed investor important to understand that when you're looking at ASR, it isn't looking so bad as the numbers might suggest. Okay, having said that, to sum it up, from a combined ratio, for me, MetLife is already clear and out. I'm not even going to dive further into the details there. But let's look now at the next one, is the price to book. And this is typically the book value, is what Warren Buffett was always talking about in the good old days when he was analyzing a company. And one of the things to look at as an insurance company is the book value, because it shows you like the shareholders' equity compared to the current market cap of the company. It suggests that if the shareholders' equity is less than the market cap, that the company is attractively priced to consider owning. And what we can see here is that from a price to book value, the Dutch insurance companies do really well. Specifically, NN Group seems to be very much undervalued, and the other companies have around 1 or even more in the case of AFLAC. So what it tells me is that AFLAC is the most expensive of the bunch. But look what is interesting here as well. The companies with really good underwriting policies and capabilities tend to be higher priced by the market, and maybe rightly so, yeah, because those are income generating businesses. The only one here then that is a little bit maybe mispriced is ASR and maybe even NN Group, because still it's not doing so bad. Although I must confess, I went into NN Group and looked at the historical performance. It doesn't look so well. Most of the price appreciation and most of the dividends are just being paid because it comes of such a low basis. But operationally, I find NN Group not so strong. Maybe a little bit more about that later. So from this point of view, you could argue that Munich Re and Allianz are already fairly priced, because the shareholder value in the company, you pay already more of that via the current share price for what it's worth in the books. And it's important because from an insurance company, if you're just about break even making on your insurance policies, then what's left for you is really the investments in the shareholder equity from a value point of view. And you want to see that growing as well. However, sometimes the book value itself is not really representative, because there might be a lot of goodwill on the balance sheet still. So if we strip out the goodwill and look at the price to tangible book value, you can see that Munich Re and Allianz look actually a little bit worse, because they still have a lot of goodwill on the balance sheet, as you can see. So from that point of view, it's really also good to take this into consideration, because goodwill is just what you overpay for a company or policies that you acquired in the past. There's no value really behind it, and you need to put them on the balance sheets to recognize for this. And what we can see here is that both the two German companies have a lot of goodwill on the balance sheet, and that's why you could even argue that they are just as expensive currently as AFLAC. For me, AFLAC, by the way, from all 5 here, or 6 actually, is really standing out, because AFLAC has the best operating is the best operator here when it comes to underwriting insurance policies, and they just look really good. So if you think about a high quality company out of this list, the highest quality company by far is AFLAC. The question is just, is it fairly valued? Now that we know the book value, the book value is also a snapshot in time. What we then want to see is really the return on equity. So the equity is what we as shareholders own in these companies, and we want to have a good return on it. And we don't want to look at insurance companies necessarily at return on invested capital, because there are a lot of liabilities in this balance sheet. Because if you look at a balance sheet like, for instance, the one from ASR again, you can see here that the equity is around 7.3 billion. But if we then look at liabilities from insurance contracts, 38 billion, 14 billion. So overall 67 billion. It stands in no comparison. So we don't need to look at return on invested capital here. It's much better to look at return on equity from that point of view. And this is also where the famous quote from Warren Buffett comes in about float, because it's collecting premiums, these insurance companies, and in the time between collecting the premium and paying out to the clients, you want to generate a return on that. That's what you generally do. Of course, based on the liabilities here, you want to generate some. But this is still a little bit artificial. And this can also be really, really high, because debt to equity, as you can see here, is like tenfold almost. So it makes no sense to even look at that. And the benefit of the float, so the investment returns, go directly as a benefit also to the equity, because it ends up in the retained earnings on the balance sheet here. And here are the retained earnings, as you can see, in this case 5 billion for ASR. So let's go back to this pack of 6 stocks. So if we then look at it from a return on equity point of view, if we look at the net income here that the companies have been generating, and then the total equity, we can see that NN Group, Munich Re and Allianz are around 10%. And also MetLife. For me, I would like to see such companies return more than 10%, yeah, because we want to be far beyond the cost of capital. Now, what we can see is that ASR and AFLAG, again, AFLAG are scoring really high. What is important here again, that for instance, ASR here, it had also a positive one-off in the number. So if you take this one-off out, I calculated it rather comes out around 11.5 to 12%, yeah. So this 14% is a little bit overly optimistic from ASR, but still in the green, I would say. Now, last but not least, I just spoke about other income generated also from investments. And here you can see that if we look at the net income, this from underwriting the policies and such, but if we look at really, for instance, the revaluation of the investment portfolio and such, we want to look at other comprehensive income. And this is really interesting here because these companies, all of them, almost except ASR, have generated a loss last year on the other comprehensive income. It was just a bad year to be invested in bonds, for instance, last year in the stock market. ASR, because of the one-off, they are still positive. Otherwise, they would have also been negative. But overall, we can still see that ASR, Munich Re, Allianz, and AFLAG were all generating positive returns. So, having said that, if I were here to pick 2 or 3 companies out of this stack of insurance companies, I would go first with AFLAG from a quality point of view, ASR from a future potential point of view, and NN Group from a current valuation point of view, but limited growth expected. Now, if you want to know what the company's worth are, I will not explain this to you all about AFLAG. I will link a really great article from Thiago Diaz, one of my friends, in the description of this video. He has it written all out for you if you want to go all into the details. But what is really interesting, that his company valuation currently is around $64 per share. So read this article, it's really good. It's a series of 3 articles and he has done a much better job than I would be able to do to you today. And remember, AFLAG is currently trading around $65, so you could say it's fairly valued at the moment. There's not a lot of upside right now, so you might probably want to look for better opportunities. So if we then have a look at ASR, the other company that I find quite interesting based on this benchmark, generally I would say the dividend is safe. This is based on a calculation that I have built a dashboard around. It takes all kinds of topics into consideration, like did the company show any growth? Do they have a healthy balance sheet? Can they afford to pay the dividend? And has the company shown commitment to the dividend? And what are the company's growth prospects? So one thing first, don't look at free cash flow when you're looking at an insurance company. It really makes no sense because of the whole investment portfolio. You will just get confused looking at it. Insurance companies are already very hard to analyze, but I found generally the net income or the earnings per share the best indicator, besides the return on equity and some of the other metrics I just showed you, to come to a conclusion about the valuation of an insurance company. So having said that, based on all of these things, like the balance sheet is really healthy, credit rating A, debt to equity even still looks good if you look at the basic debt details, interest coverage of 4, so they can easily pay the interest on their liabilities. They have been growing the dividend ever since they got an IPO with a strong dividend growth record of 14% almost. And also during the pandemic, they were still able to increase the dividend, although the government was withholding or asking financial institutions to not pay a dividend, and they paid it back later into the year. Payout ratio also still healthy, below 50%, so I see no reason why they wouldn't be able to pay out any further. When I look at the growth prospects, this is a slow growing business. That's why I put it neutral. There's not like a strong industry tailwind or something like that that will now, like Microsoft, like give it many years of stellar growth coming up. No, it's just your general boring insurance company paying a very attractive yield. So what I then would like to look at in ASR is how has it been doing over the last few years. So let's look at also at their facts and figures in the annual report, which I found really helpful. They have been growing generally the equity per share, but what they have also been growing are the written premiums. So it went from 4 billion to 5.9 billion almost in 2021 in 5 years, which is really good growth. And I see no reason why ASR would be stopping anytime soon. I read through their annual report and they have quite a good strategy, I must say. And while they have been growing the written premiums, you can also see that the combined ratio has been slightly declining, and their goal is it to be around 93. Last but not least, their dividend is easily covered because you see it's 329 million right now on a net result of 942 million. But even if you take last year into consideration, it's still easily covering the dividend. So from a dividend safety point of view, also here, very well. The credit rating has been stable. So actually, I see no issue from this company going forward. So let's have then a look at the valuation and how the company is currently valued. I believe that the company, like AFLAC actually, should be valued around 65 euros. How do I get to this number? I took a baseline number of earnings per share net income of 700. Remember, 700 is not too much, right? If you look at the average, it was actually more. It was probably more like 800, but I want to be a bit conservative. They had some one-offs this year, so that's why I put it on 700. If we then look at a growth rate in the next 5 years of 4% and then 3% thereafter, and a 10% discount rate and a terminal multiple of 13, the company should be still worth 64 euro. And remember, the company is now trading at 41 euro. So I think the company can do much better still, and it is still quite some room to grow. And I think it could still grow by around 50% if you think about it. At the same time, you get currently a yield of 5.8%. A strong dividend growth, although I think it will be not so strong anymore going forward. I think this was really stellar in the last few years as a result of their IPO. So probably the best time was actually to buy already a few years ago. But hey, sunk cost, can't turn back the clock of time. So from that point of view, you could even be more optimistic. If you think like my numbers are quite conservative and you would rather go with 6% growth forward, 4% and a higher multiple of 15, you would be talking here about 77.1 euro. Now, from that point of view, I want to also make you aware that currently the price to earnings is 7.3. So, of course, on elevated earnings. So, if you look at the forward per PE, it's 8.3. So, most of it, in my opinion, should come from earnings multiple extraction, which I think is not really unfair to ask, specifically what we just saw in a rising interest environment. If interest rates also start to really rise in Europe, then a company like ASR will do really well. So what will I do with this information? I have decided to initiate the position when the stock price hits 40. Why 40? Just because it's a nice round number. I already made my purchases this month, so I don't need to buy it at this price now straight away. I can wait a few weeks still to get it because my new money from salary is coming in. So I put a buy order at 40. If it hits the price, I'll be a lucky owner of ASR at about a yield of 5.9 to 6% dividend, which is for me a really nice starting yield and a yield that I believe can grow still in the years to come. Having said that, I hope you enjoyed this video. I'm not going to look into the other companies. I think they are not attractive enough now to look further deeper into it. That's why we do screeners, right? So based on that, hey, I hope you enjoyed it. If you want to learn more about how I value companies, look at the video on the left. If you just want to have some inspiration about another stock, please look at the value of the right. Having said that, have a good weekend and see you again.